Welcome to the Earn Your Marks podcast, presented by Pro Exam Tutors, the only podcast you need to pass the CFP exam and become a certified financial planner professional. Here's your host, Sev Meneshian.
Okay, welcome to the Earn Your Marks podcast. I'm Sev Meneshian with Pro Exam Tutors, and I'll be flying solo today without my podcast partner, Nelson Green. Nelson and his wife just welcomed their first baby just a couple weeks ago, so congratulations to mom and dad there, and we look forward to having Nelson back soon. Today, I'm happy to be joined by Jacob Hartz. He's a managing director at NFP Insurance Solutions out of Chicago. They're an independent insurance brokerage and advisory firm. And as far as Jacob is concerned, or more about Jacob, he earned his JD from Cardozo School of Law with an emphasis in trusts and estates, partnership, and federal taxation. He also advises wealthy families in regard to their estate planning needs, using life insurance, premium finance, wealth transfer strategies, and business succession solution. He's also a member of the Chicago Estate Planning Council. The last thing before Jacob starts to talk about his experience and how he works with wealthy families and so on is that he's also an adjunct lecturer at Northwestern University School for Professional Studies. He teaches the risk management and insurance planning module of the CFP curriculum. And with that, Jacob, I think we can just say we're out of time almost. But that's a good introduction. You have a heck of a resume, and from what I also understand is you're doing a way better job than your predecessor who was teaching insurance at Northwestern.
I don't know if that's true. I think I have some pretty big shoes to fill over there.
No, thank you, but no, it was a good run over there. But life happened, and all of a sudden there are 3 kids in the picture, and we're living an hour away from the city, so I couldn't make that trip consistently anymore. So, but what I figured we'd talk about today is that we're right in the middle of the CFP exam, the first exam. Let's say not session, but cycle of the season. So we've got a lot of students that are understandably freaking out about things. And I thought it'd be perfect to have you on because you have this great mix of practical knowledge in the areas that students are tested on. And then you've got the, let's say like the book knowledge or the ability to then take those ideas and then bring those to CFP students as an adjunct lecturer. So my first thing that I wanted to go over is if generally speaking, and I'm doing this so we can paint a picture for the students out there, how do you use life insurance just in your everyday practice? Like what are some of the typical ways that you use it, and what do the clients in your group, what do they typically look like as far as wealth and income and so on?
Sure. Well, most of my practice is life insurance. So how do I use life insurance in my practice? It's really every single day and the majority of what I do. That said, there are a couple different types of clients that we primarily work with. Mm-hmm. And I could probably categorize them with 2 different handy acronyms. The first one is Henry, which you may have heard stands for high earning, not rich yet. Yep. Which I think is a very descriptive way of describing high earning professionals who are saving a lot of money, maybe earlier in their career, but haven't actually accumulated a significant amount of wealth in the bank, so to speak.
Okay, so they're getting there, or they're on the right path for sure.
Correct, exactly. And then the other group is what people refer to as high net worth or ultra high net worth, HNW, UHNW, people who, and everyone has a different cutoff for what they consider to be high net worth. I just in general group all of those people into the category of they're worried about an estate tax liability, a federal estate tax liability. So right now, call it rule of thumb, families that are at the 25 million or over mark. Mm-hmm. And, it's a broad range because that extends, into the billions for families that fall into that range. Right. So there are different things that you do for families of different sizes, but broadly speaking, federal estate tax territory.
Got you. And it's interesting that the wealthier that an individual or a family becomes, the concern is less and less, just from my observation, less and less about the earnings, and at some point there's a tipping point where it's not mainly, but it's the very heavy focus on taxes, reducing or even possibly eliminating taxes.
Right. Okay. And wealth transfer, passing things on to the next generation, and being as efficient as possible with that.
Got you. And then when you're saying efficient, then you're talking about that we're gonna move assets from person or family A to person or family B. We want to do it the lowest tax cost possible. Which brings us to the point as far as or the topic as far as like in the insurance module is concerned. So you teach the insurance module, the CFP curriculum. There are things in there that we discuss as instructors as far as, okay, how we're going to deal with high net worth or ultra high net worth families. But what are some of now, life insurance is the main tool. Are there other tools that are used and then also that you teach about?
Sure. I mean, there's trust planning and using trusts to reduce the taxable estate. Okay. Obviously, depending on the feasibility of these different strategies, you can use trusts to move assets out of the estate through various means, whether that means just using up the lifetime exemption with direct gifts, or more sophisticated things like using grats or a sale to an intentionally defective grantor trust. Okay. Things that are a little bit more sophisticated and that probably kick in a little bit more for clients that are maybe in the 50 to 100 million and up range. Okay. But for those who are kind of sitting in the 25 to 50 million range, just simply moving assets into trusts, whether it's we see a lot of people using SLATs, which are spousal lifetime access trusts. It kind of allows clients to move assets out of the estate, but still maintain a certain degree of access to the assets inside the trust through their spouse. And that's a topic for an entire podcast. Any of these are going to be topics amongst themselves, but these are the subjects that we talk about outside of just strictly life insurance. And then of course there are a lot of charitable strategies that use trusts and charitable purposes that allow clients to retain some access to that capital during their lifetime, or a stream of income. Okay. But ultimately the beneficiary is a charity or there's a charitable purpose associated with it. So it allows clients to reduce their taxable estate, maintain some either control or access to funds, but still, be efficient with their strategies. And if they have a charitable purpose anyway, then it all kind of dovetails together nicely into, some good planning. Okay.
Now, there's one thing that you mentioned at the very beginning, and I believe you mentioned grants. And so grant to retained annuity trust. We know that this is a topic that comes up on the exam. What tends to give students a hard time, and not to fault the books, but there's only so much that you can do when you're trying to explain something through a book. Now, somebody might be more receptive to watching a video or talking about something. So when you're talking about a grant, if we place, for example, $10 million in a grant or retained annuity trust, one of the areas that I've noticed students get tripped up on, and maybe clients as well, is that if we place that $10 million into the trust, that is irrevocable. So that's gone. That is, initially, we can say that's out of my estate, but I'm retaining a certain amount of income. Let's say that I'm retaining 5% of that, so $500,000 per year. When we get to the end of that trust term, or I should say, when we're setting up that trust, let's say we have $500,000 payments for 10 years, so a gross amount of $500,000. How do we get to the present value of those future income payments? That's number one. And why is it important that we know what the present value of those future income payments are when we're funding that irrevocable trust?
Well, that's a good question. I mean, you want to know the value of that when you're assessing the value of the strategy, and the efficacy of the strategy. And you also want to understand that for purposes of understanding how much you're actually retaining in your estate, and what's the value of that gift to the trust.
Okay. So there's a discount rate. So we'll use the 75/20 rate, correct? The discount that $500,000 payment per year.
Right.
Okay. So after 10 years, we can say that, that those gross payments that I received of $5 million over that 10 years, they were really worth the present value of those were $3 million. So we can accurately say that, okay, I'm getting $10 million out of my estate right now, but the IRS needs to know right now what the present value, or they need to know right now what the value of that gift will be. So the present value, we're calculating it so that we can determine ultimately, well, what the gift tax consequences will be on that, for example, remaining that balance of 7 million.
Right.
So is that okay? So yeah, for exam purposes, I think that's one of the areas, and you may have seen this in class too, or you may have a different experience, but do you see students struggling with that area as far as like, why are we getting the present value? What's that all about?
Yeah, absolutely. And I mean, that's one of the more kind of challenging calculations that they would have to do and understand the purpose of that. And that really that falls under the the estate planning section of the exam that is very important.
Right.
And it's something that we see kind of in practice when we're working with attorneys, that we have to be mindful of when we're recommending those kind of things to clients. And so it's very important for students to kind of understand that for the exam. Absolutely.
Okay. And okay, well said. And then as far as a GRAT is concerned, is there any need, or is there life insurance planning that's involved typically with a GRAT or a GRUT, or are we typically placing assets in that are, for example, highly appreciating assets?
Well, you are putting in highly appreciating assets because you want to make sure that they overcome that hurdle rate, and you get a lot of the growth of those assets outside the estate, inside the trust, right? But a lot of times what I like, and this is with GRATs and trusts in general, when a trust owns life insurance, a GRAT is just a good example of a trust that owns income generating assets. Okay. So when a trust owns income producing assets, I think that's a great place to own life insurance in a trust, because it allows the income generated by those assets inside the trust to fund life insurance premiums.
Perfect.
And it reduces the grantor's responsibility to fund those premiums themselves.
Okay.
Which, again, if you're in a situation where you've exhausted your lifetime exemption, and maybe the premiums on the amount of life insurance that you need from an estate planning point of view are, in excess of your annual exclusion allowance, then income generated by the trust assets is a great source of premium dollars.
Makes sense.
So I've done this with a lot of different kinds of trust. But usually the type of assets that people are putting into a GRAT are already the type of assets that are generating those annual payments.
Okay, perfect. And that would be an example, as you mentioned, as a funded trust, because this is an area of confusion I've seen before, because we might come across let's say on the exam side or on the CFP exam side of things, there's a distinction between a funded trust and an unfunded trust. A lot of times students are looking at the terminology of a funded trust and they're like, well, the guy is writing he's writing the premiums and he's paying, isn't that being funded? But so, we'll remind students that, and the example I give is a basic example, is that we might want to put, for example, real estate in there just to paint a picture for students, because the real estate produces rent and then the trustee can take that rent payment and carry it off to the insurance company.
Exactly. Yeah, that's a great example. I mean, real estate is maybe it's just a Chicago thing, but there are a lot of real estate clients here in Chicago. Real estate's a huge industry here.
Oh yeah.
And so those types of clients are great candidates for using life insurance in a trust. And I'll just back up for a second to explain why that is.
Mhm.
And when I mentioned the amount of life insurance that a client might need for estate planning purposes, I think it's worth taking a second to explain what that means and what life insurance for estate planning purposes entails.
Sure.
So this is kind of skipping ahead past the Henrys to using life insurance for estate planning for people who are above that exemption limit. And really the way that we kind of use life insurance in a textbook sort of way for high net worth clients, especially ones with illiquid estates, is we look at, in conjunction with their financial advisor, their financial planner, their attorneys, everyone, all the advisors in their world, who kind of agree on a projection of how much estate tax are you going to owe, at the end of the day upon death. And we solve for that number. So if the number is $10 million of estate tax that we're projecting that this client is going to owe, whether we're looking at that as, this is what you owe today, or we're projecting out to life expectancy, either way, it's really what the advisors and what the client are comfortable with using as their, as their benchmark.
Okay.
I kind of take the approach of which asset is going to pay that estate tax. Is it your account at the bank? Is it your real estate portfolio? Is it a piece of your private business? Is it your yacht? Is it your art collection? What is the asset that's going to fund that $10 million estate tax bill? And usually, if you list all those different assets, none of those are assets that a client is really looking to part with.
Probably not.
So yeah, so it's especially when you start talking about luxury items, big ticket luxury items, things like that. Especially if the next generations are involved in the conversation, they certainly don't want to see those sold off to pay an estate tax. So using life insurance to fund that estate tax bill is really the exercise of putting life insurance inside a trust. So when it's in a trust outside of the estate, and I should say an irrevocable trust outside of the estate, it's not included in the estate. So when the client dies, the life insurance pays into the trust. Then the trust uses that cash to buy whatever assets it wants from the estate, providing the estate with cash, and then those assets go into the trust.
Okay.
And so, and remember, there's a step up in basis upon death, currently at least. So, we'll see if that survives the Congress.
If that changes, we got a lot of panicked students.
Exactly. Yeah, it was kind of close to the chopping block a couple of years ago, but at least currently it's you get a step up in basis. So when the trust buys those assets, there's no, in theory at least, no capital gains tax due on that sale. So it's a way for the estate to get its hands on some cash without incurring, capital gains sale from the capital gains tax from the sale of any assets.
Okay.
So that's what I mean by providing the amount of life insurance that you need from an estate planning perspective.
Now, there's a couple things. So I want to go back to the 3-year clawback rule just for a moment, but what if, let's say if you're anticipating an estate tax bill, I think you said of $10 million, we'll just make up a number. What if you expect that to be the planner and the clients and everyone involved expect that tax liability to be $30 million further down the road? Is there a specific type of design for life insurance policy that we can use to get ahead of the game?
Yeah, absolutely. That's a great question, and that gets into really product design and case design. So we can back up a little bit also, because this gets back to one of those questions that a lot of students have about the different types of life insurance, whole life, universal life, and the various flavors within universal life. So whole life insurance kind of by its nature has an increasing death benefit every year.
Okay.
Universal life insurance, you have to check the box to get a increasing death benefit.
Okay.
I kind of like to, and you can choose a level death benefit or an increasing death benefit. When you have a scenario where the client is maybe younger, and they have, as you said, maybe there's a $10 million estate tax bill if they drop dead today. But if we pull it out to life expectancy and, taking into account the expected growth of the estate and, other planning that they might be doing, maybe at life expectancy, the estate tax bill is 30 million. I would design that with an increasing death benefit, so that we hope, at least based on projections, and projections are hypothetical and we may be wrong, but at least we're getting into a ballpark where we hope that the life insurance policy's growth from a death benefit perspective will keep up with the estate tax bill.
Okay, got you. And then that will be right. That's your job, or you're discussing that with the other advisors on the client's team. So there's a lot of number crunching. I mentioned something about a 3-year clawback. So if we're going to take a life insurance policy, and you had mentioned purchasing, but what if we gifted it to a trust, or if we gift it, and that is an irrevocable gift that we've made, we die within 3 years of placing that policy in trust. And the death benefit's 20 million. So what happens at that point?
Well, that would be an unfortunate occurrence, not just because the client dies and everyone's sad, but because the policy is clawed back into the estate.
Okay.
And so one of the ways that we avoid that, where possible, and this is where a funded trust is good to be working with, instead of gifting the policy to the trust, I think it's a good idea where possible to sell the policy to the trust.
Okay, that way the client unfortunately dies tomorrow, then that's not clawed. The 20, 30 million, $50 million death benefit, whatever it happens to be, is not included in the gross estate.
Exactly.
Okay.
Exactly. Yeah. And I think, we can, there are situations where it's either attractive or not attractive to buy the policy, or should I say, for the grantor to sell the policy to the trust, depending on the value of the policy at the time. Sometimes you can, depending on the timing of the sale and how many premiums you've put in the policy and what the cash value is, you can almost make you can make that more attractive to sell or gift. If the policy has, for example, a very low cash value, but you've put a lot of premiums into it, the trust can buy the policy for, kind of like the lower of that amount, essentially, or they figure out what the value of the policy is at the time. And it's a way to be able to get a policy into a trust without using up a ton of gift bandwidth.
Okay, which is another one of the names of the game, I suppose. With life insurance, the interesting thing is that, when I first started my career in financial services, my understanding of life insurance was, okay, there's term, and we've got a new couple, or they're going to have a child or children, and we want to make sure that the death benefit is there in case we want to pay off the mortgage, take care of wife, husband, or whomever, family, let's just say, generally speaking. It's interesting that then as my career developed, the favorite tool for planning really has become life insurance. It is so versatile. When I'm teaching a course, or when you're teaching, I'm sure both of us can probably right off the bat just name 10 different uses for life insurance. It is the most flexible, probably the most powerful tool in the toolbox of the planner.
Absolutely.
Would you mind, could we review, because this comes up a bit, the crummy trust? I know that's more on the estate planning side, but it's got a life insurance component. Can you discuss the whole idea of a crummy trust and what this 5 and 5 power is? Because that is a confusing subject. And I know that crummies are used they don't, you don't have to, let's say, be ultra high net worth to benefit from a crummy trust. So could you talk a little bit about that?
Yeah, absolutely. So a crummy trust is, a very old form of a trust, named after, I think it was Clifford Crummy was the guy who used these a long time ago. I don't remember the exact date,
He was a
but
dentist or something, wasn't he? Or
what's that?
I think he was a dentist, or
I think so. Yeah, he was just kind of a regular guy,
oh, okay.
and and the idea with the crummy trust is essentially that the grantor can put money into the trust, and the way that it functions is the beneficiaries have, I think, a 30 or 60-day window where they can access the gift that was put into the trust.
All right.
So it's important to note not the entire corpus of the trust, just the gift of that year.
Okay.
And they have to be given a notice. It's called a crummy notice, that the gift has been made. And they have the right within that time window to take that gift.
Okay.
And then once the window closes, then they don't have any more rights to take from that gift, but they do have a right to this 5 and 5. So it's either 5% of the trust corpus or $5,000.
And the whole point there, when you're opening up that window for 30 or 60 days, now the beneficiaries have to be notified. This is probably going to come from an attorney, I assume, like a family.
Yeah. Yes, exactly.
Okay. And the whole point is that if we're placing assets in trust and we're immediately closing that door and we're saying, well, you can't get to this until the life insurance policy that we've placed in trust pays off, which means I'm going to die in the future. Obviously, you can only die in the future, I suppose. And then the problem is that that's a future interest gift, so we're not qualifying for the annual exclusion. So by opening that door, that window for 30 or 60 days,
right, that makes it a present interest gift.
Perfect. Yeah, and then and at the same time, it's a completed gift. So we have to check both of those boxes. So
right.
Okay. And if you have, do you have a couple more minutes just for a couple of topics?
Absolutely.
Okay. For one thing that trips up students is, and probably plan administrators as well, is the life insurance in qualified retirement plan. So I'm curious, why are we putting life insurance in a qualified plan? And then, what's the benefit to the employer? What's the benefit to the employer? And are there any special, let's say, tax considerations that either the employer or the employee have to be worried about or concerned about?
Yeah, absolutely. And, I'll talk about qualified plans. And, if we have a minute or two, I'll also mention non-qualified plans, because I think a lot of the stuff that we see, at least that I see on the kind of executive benefit side of things, falls under the non-qualified side of the house. But on the qualified side of the house, so used to be called 412I, now is 412E3. They updated the section there.
Yeah, when I learned it was 412I. So I still write 412I, yeah. and I know very well it's E3, but it's one of those things. It just
right. Right. Yes. Hard to let go. But basically it's the idea of using life insurance and annuities to fund a defined benefit, essentially a pension plan for employees. And the benefit of it for employers, that it's tax deductible, the contributions.
Perfect.
And employers are always looking for ways to make tax deductible contributions to employees. And it creates a guaranteed retirement income stream, essentially. And these plans can actually only be funded by annuities or a combination of annuities and life insurance.
Okay, so there's no testing to these, because let's say that the actuaries at the insurance company is guaranteeing the benefit. So there's no
Right.
need for rigorous testing.
Right. So it cuts down on administration and things like that. It's typically a pretty simple and elegant plan to implement, usually geared for smaller businesses. It's nice because obviously the buildup of the value of that pool of funds that's going to pay out is like life insurance and annuities, tax deferred. And then, when it pays out to the employees, it's a very reliable, predictable, guaranteed stream of income.
Okay, so it's like you're building your own pension plan, because you said this is
Right.
where you'll see a lot of these in like doctor's office, lawyers, the legal firms where we have a smaller number of executives or owners, let's say.
Exactly.
Okay.
Yeah, and these days, when pension plans are mostly a thing of the past,
Mhm.
there are a lot of employees and employers that actually kind of like the idea of having that certainty of an income stream in retirement. The pension plan was largely replaced by the 401k, and the burden has kind of shifted to the markets to fund people's retirement.
Right.
Versus the burden being on a company or something like that in the past. And so having these available to employees is kind of a nice way to guarantee some security and give people a sense of certainty that they'll have money coming in every month during retirement.
And when you said certainty, and we won't have the time to talk about it today, but maybe at some other time, when you said a guarantee or giving some degree of certainty to the executive, then the rabbi trust comes to mind.
Yes. So the rabbi trust is a really nice tool because it allows the company to put funds into a trust that are held for the benefit of the employees upon their retirement. The nice feature, or a couple nice features of it. One is that when funds are put into the rabbi trust, they're not considered taxable to the employee. So even though they're being put there for their benefit at that time, they're not taxed on it until they actually get distributions from the trust.
Okay, and the assets are put aside, but are they still technically just considered the property of the employer? Or
no, so that's the nice thing. So I mean, they are to the extent that if the employer files for bankruptcy, they would actually be attached in a bankruptcy proceeding. So they're not protected from creditors, but they are protected from the company doing whatever they want with it in the meantime.
They change their mind. We have a new executive, a new board comes in, and we don't like this guy. We're just not going to pay you any longer.
Right.
So
exactly.
Executive from that. Okay. Interesting.
Exactly. So it's not just a slush fund for the company. It's really, it's earmarked for the employees. But again, administration wise, a little bit cleaner than, having, a full kind of like third party administrator type of a scenario.
Okay. Makes it easier for the employer. Okay.
Exactly.
And gives that sense of security to the employee or to the executive or, whomever is going to be benefiting.
Exactly.
But in that whole thing, as far as not being taxed, though, to the executive or the employee, is that we have a substantial risk of forfeiture there. So the company could go bankrupt, or you have creditors that are standing in line. I mean, they're basically neck and neck with the executive, correct? I mean, they both have claims. They can have claims to it. Okay.
Exactly.
Let's say, in the interest of time, can you talk just a little bit about a split dollar policy? What do we use it for? Just generally, how does it work?
Absolutely. So split dollar just means that the premium payer is different than the policy owner or the beneficial owner, shall we say. So it can come in two different flavors. There's the loan regime and there's the economic benefit regime.
Okay.
So if we're talking just about, and by the way, this comes into play for executive benefits in a corporate setting, and it comes into play in estate planning as well. So there's a lot of intergenerational split dollar arrangements among families. Although in this context, I think we're mainly talking about corporate-based split dollar arrangements. So in the loan regime, the employer basically loans the premium to the employee to fund the policy, and the employee either pays interest to the employer, or that interest accumulates and they eventually owe the interest.
And they'll pay the equivalent of, let's say, phantom income on that interest if they're not.
Correct.
Okay.
Yes, if the employer is forgiving the interest, then they have to pay tax on the value of that interest every year.
Makes sense.
So it's not a free loan. They either have to pay the interest or pay the tax on the forgiven interest.
All right.
And so in the meantime, the employee, owes those premiums back to the employer, which is a way for the employer to place some golden handcuffs on the employee to a certain degree. But the employee can assign beneficiaries. They can use the policy as they see fit, essentially, unless there's some kind of restrictive covenant on the policy, which does happen fairly often. But for the sake of brevity, the employee owns the policy. The employer loans the premium to the employee. And if later on the employer decides to forgive that loan, then again, that's a taxable event for the employee. Exactly. But they can tap into the cash value of the policy to pay that tax in theory. Or the employer can give them a double bonus to pay the tax on that forgiven loan as well. There's a lot of different ways that they'll arrange that. Kind of the beauty of these arrangements is that they're very customizable, and they're meant to fit the needs of a very small subset of executives at a company. So they can be kind of individually negotiated and tailored to fit the needs and goals of the owners and the employees.
Okay, so that goes back to the flexibility of life insurance. I mean, it is
exactly
very, very flexible tool. So in one case we have the employer who it sounds like is just making in one way or another is making a loan to the executive, so the executive can pay the premiums.
Mm-hmm.
Okay, so that's one route. We've
got
another route, and is there a preferable route to take? I know that it'll depend on the circumstances.
Right. No, that's a good question. So the other route is called economic benefit, which is where or endorsement split dollar. So in this kind of scenario, the company actually owns the policy, but it allows the employee to assign the beneficiary. And so the value that the employee gets from that arrangement is the economic benefit of having that life insurance. So that economic benefit amount is something that's calculated on an annual basis. And, frankly, it's typically a fairly de minimis amount. It's basically the amount that life and 1 year of term for that amount is worth, is kind of a way of thinking about it. So if you have a $2 million policy, even if the employer is overfunding it with a lot of cash value to create, an asset that they're eventually going to give to the employee, the economic benefit of that $2 million of death benefit to the employee's spouse or children or whoever might only be a couple $100s a year. So that's the amount that's the amount that the employee is on the hook for. And that can be very attractive to the employee from a cost standpoint, but they have no control over the policy.
Okay. So you've got the two different types. And again, it'll just be dependent upon what the employer and what the executive or the employee wants to accomplish. So
exactly. And if you think about this as a retention strategy, usually these arrangements have an end date to them. So this might be a 10-year arrangement, or until age 65 arrangement or something like that, where the goal of it is to attract and retain top talent.
Okay.
So the retention part of it is in the loan side of things is, well, if you leave or you're fired, now you're on the hook for this loan and we're not going to forgive it. So that's a pretty powerful tool.
So we're tethering the executive to, or the employee to
exactly.
the company. It's interesting. It's interesting because then if anyone is interested in reading up more on split dollar, your office, NFP Insurance Solutions, actually contributed to an article about Jim Harbaugh's split dollar policy. And I can't remember the outfit that it was. I almost want to say USA Today did
I forget the outlet as well. That was several years ago, but Jim Harbaugh probably had the most famous split dollar comp agreement in America.
I think so too. And I think if I remember, it was in the article, but it was in the tens. It was up there.
Yeah. It was pretty
significant. It's interesting.
I think at the time it made him the most highly compensated college football coach. And the reason it got so much notoriety is because a huge amount of that compensation was tied up in this split dollar life insurance deal.
Oh, see, I don't remember. I just remember the big numbers, but I don't remember why. I think his comp at that time, it was made public. It was who knows, $5-6 million a year, and
right.
The deal was being sheltered in a sense. So
exactly.
Well, Jacob, thank you. It's definitely been a pleasure talking with you. And I hope we get to do this again. Just as a reminder for those of you that Jacob is he's a managing director at NFP Insurance Solutions out of Chicago. So very successful. It's a very successful firm. And so again, thank you, and hope to talk to you soon.
Thanks for listening to this episode of the Earn Your Marks podcast. For more information or to get in touch, visit us at proexamtutors.com.